It was October 2012. The lights were going out, not just on a building, but on an empire. For decades, the name Hee-jin meant education, construction, energy. It was woven into the very fabric of modern South Korea. This conglomerate, built on sheer ambition and relentless expansion, once boasted assets well over $6 billion, touching the lives of millions through its massive tutoring franchises and construction arms. But ambition, untethered from reality, becomes a catastrophic liability. We see the final, agonizing moments. Restructuring plans collapsing, emergency loans drying up, and then, the final gavel strike. The overwhelming realization that the debt load was unsustainable, reaching an staggering $8 billion. Imagine building a colossus, brick by painstaking brick, only to have the foundation suddenly turn to sand. Chairman Yoon Suk-cum, the architect of this sprawling vision, watched as his legacy dissolved into bankruptcy filings and asset seizures. The scale of the implosion wasn't just financial, it was personal, shaking investor confidence across Asia. How does a company that seems so untouchable, so entrenched in the national economy, spiral so quickly into ruin? This wasn't a simple market correction. This was a structural failure born from hubris, debt accumulation, and a terrifying inability to say no to the next big acquisition. The narrative we are about to dissect is the slow-motion train wreck of an industrial giant, propelled forward by borrowed billions and blinded by the glare of past successes. We begin not at the start, but at the very end, standing amidst the ruins of what was once considered invincible. What critical errors, buried deep within the subsidiary ledgers, allowed this $8 billion debt bomb to tick for so long, waiting for the precise moment to detonate? Sound of shattering glass fading into dramatic underscore. Welcome to Crashivist. Today, we rewind the tape to examine the spectacular unraveling of the Hee-jin Group, a cautionary tale often overshadowed by the larger collapses of Daewoo or Hanjin, but arguably more insidious in its complexity. The protagonist of this drama is Yoon Suk-cum, a figure synonymous with aggressive, high-stakes capitalism in South Korea's hyper-competitive business landscape. Yoon wasn't born into traditional chaebol wealth. He forged his empire starting in the 1970s, initially focusing on humble textile manufacturing before making a pivot that would define his entire trajectory: education. By the 2000s, Hee-jin was the undisputed king of private tutoring, its Hee-jin Think Big division becoming a household name, synonymous with scholastic pressure and guaranteed entrance into top universities. This cash cow generated the necessary liquidity, but it also fostered a dangerous mindset in Chairman Yoon: the belief that any business he touched would turn to gold. By 2009, the group's total annual revenue was cresting nearly $3 billion, employing tens of thousands, making it a significant economic anchor. But beneath the glossy exterior of educational success, the debt was already mounting, driven by Yoon's almost compulsive need for scale and diversification. He began acquiring assets far outside his core competency, treating the group's robust cash flow not as profit to be secured, but as collateral for greater leverage. He purchased failing construction firms, energy ventures, and even attempted forays into media, all financed heavily through loans and bond issuances. The key to understanding Hee-jin's downfall lies not just in the size of the debt, which eventually ballooned past the $8 billion mark, but in the asterisk quality of the assets backing that debt. Many of these acquisitions were deeply cyclical, capital-intensive, and entirely unrelated to the stable education sector that provided the initial fuel. Yoon Suk-cum, despite his undeniable business acumen in the tutoring sector, developed a severe case of entrepreneurial tunnel vision, prioritizing growth above prudent risk management. By 2010, analysts were raising flags about the increasingly precarious debt-to-equity ratios, especially concerning the group's massive real estate holdings, which were subject to the volatile South Korean property market. Yet, Chairman Yoon pressed on, allegedly convinced he could manage the complexity through sheer force of will and further leveraging. The stage was set for disaster, fueled by the perceived infallibility of the chairman and the blind faith of the creditors who saw only the historical performance of the Think Big subsidiary. The true saga of Hee-jin began decades before its mega deals. The first tremors of the real estate market began to shake the very foundations he was relying upon. Founded in 1973, the company initially focused on textiles, a standard entry point for Korean conglomerates seeking rapid capitalization. But Chairman Yoon Sok-keum was never content to remain a middle-tier manufacturer. The critical turning point came in the 1980s and 90s when Wongjin began aggressively moving into publishing and educational materials, recognizing the intense national obsession with academic achievement. This wasn't merely selling books, it was selling futures. They pioneered systematic, standardized private education franchises, essentially industrializing the path to university entrance. By the early 2000s, Wongjin's educational outreach was vast, enrolling hundreds of thousands of students annually, generating consistent, predictable, high-margin revenue. This stability was the golden goose that funded the chairman's grand expansion plans. As the conglomerate matured, Yoon began the aggressive diversification that would both define and ultimately destroy the group. The early acquisitions, such as Wongjin Kowei, water purification systems, were successful, providing strong, recurring revenue streams that masked the risk building elsewhere. By 2007, Wongjin was a multifaceted giant, holding significant stakes in areas ranging from food processing to renewable energy. The group's total asset valuation peaked near $7 billion during this expansionary phase. Yoon Sok-keum operated with the confidence of a man who had never truly faced failure. His narrative was one of constant upward trajectory. Media coverage during this period was overwhelmingly positive, hailing him as a visionary industrialist mastering the post-Asian financial crisis environment through strategic leveraging. It was the era of Korea Inc., where scale was prioritized, and debt was viewed as cheap fuel for expansion rather than a threat. Crucially, the sheer profitability of the education sector allowed Wongjin to service massive interest payments, creating a dangerous illusion of financial health. Why take out a small loan when you can take out a colossal one and still make the monthly payments? This mentality led to massive, debt-financed takeovers in the late 2000s, particularly within the construction and real estate sectors, areas that demanded massive upfront capital investment but offered lower, more uncertain returns compared to tutoring. The acquisition of companies like Wongjin Construction, requiring billions in immediate capital injection, became the historical inflection point. These secondary ventures, while impressive on paper, were entirely dependent on a continually booming real estate market, visible strain, a market that was, first, unbeknownst a series of small leaks rather than a gaping hole. Just as the global financial crisis began to bite, failure. But external economic pressure compounded by Chairman Yoon's strategic reliant on the smooth operation of dozens of disparate gears. Around 2009 and 2010, and faster, as South Korea struggled to fully recover momentum. Every successful year only reinforced Yoon's belief that the group had heavily leveraged its balance sheet, diversified to falter, simping over $3 trillion ever truly be cut off approximately $2.5 billion financial system at the time, having narrowly dodged a bullet in 2008, construction assets was far less forgiving in the years that followed, and Chairman Yoon was about to learn that liquidity, suddenly, once the massive debt payments weren't being easily covered by operational profits alone. The cash flow from the education sector had to plug holes in the failing property ventures. This is where the interconnected nature of the conglomerate became a liability. The reliable engine, Wongjin Think Big, was now being forced to subsidize the speculative engine, Wongjin Construction and related financing arms. Reports from credit rating agencies in 2010 started reflecting growing concerns over the quality of earnings, noting that much of the reported profit was tied to asset valuation rather than genuine operational growth in the secondary sectors. A major red flag emerged when Wongjin attempted to sell off non-core assets to service looming bond maturities, signaling that organic cash flow was insufficient. In 2011, the debt-to-equity ratio for the entire group crossed alarming thresholds, exceeding 300% in some divisions. Yet, Yoon Sok-keum remained publicly defiant, characterizing the downturn as a temporary market fluctuation and promising radical restructuring. He allegedly believed that if he could just land one more large-scale energy or infrastructure project, the entire debt structure would rebalance itself. This delusion led to the most fatal error: the decision to acquire the failing Hee-jin Heavy Industries shipbuilding division, a multi-billion-dollar gamble in an industry already suffering severe global overcapacity. This move, reportedly executed in early 2011, required billions in fresh credit, immediately pushing the group past the critical $8 billion debt threshold. Creditors, seeing the aggressive expansion coupled with falling property values, tightened the screws. Banks began demanding higher collateral ratios, and bond yields soared as investors demanded punitive interest rates to compensate for the increased default risk. Wongjin was trapped in a classic debt cycle, needing more debt to service old debt, while the market recognized the underlying assets were deteriorating once the creditors truly lost faith. The educational stronghold, by mid-2012, once the bedrock of the entire organization had become an inescapable gravitational ship attempting to tow a fleet of tankers. The market no longer believed Chairman Yoon's promises. The facade of stability began to crumble, overwhelming interest obligations on public admission of severe financial distress came when Wongjin had to postpone when Wongjin officially announced it could not meet its obligations related to the troubled construction and energy subsidiaries. This delay was a death knell. This immediately the market that even the cash-rich education division could no longer reliably cover the obligations access to all further short-term liquidity. Setting the stage for the final, the dominoes began to fall with terrifying speed. First, the company was forced to sell its crown jewel, Wongjin Kowei, the profitable water purification business that had been the envy of the industry, to private equity in a distressed sale for approximately $1.5 billion. This massive injection of cash was immediately swallowed by immediate debt service requirements, barely touching the overall $8 billion liability. The sale itself was a psychological blow, confirming that the group was cannibalizing its best assets just to stay afloat. Next came the forced divestitures of the construction and energy holdings, assets that Yoon had spent years acquiring, which were sold off at fire sale prices, recovering perhaps 30 cents on the dollar compared to their acquisition costs. The market watched in horror as one of South Korea's 10 largest conglomerates systematically dismantled itself under court supervision. By October 2012, after failed negotiations with creditor banks and bondholders, Wongjin officially filed for court receivership protection, a clear indication that restructuring outside of formal bankruptcy proceedings was impossible. This filing confirmed the insolvency of the core holding company. The narrative shifted from asset sales to asset liquidation. Crucially, the educational division, Wongjin Think Big, which had generated the initial wealth, was spun off into a separate entity, eventually acquired by a rival in a separate transaction, leaving the primary holding company saddled only with the residual debt and the liabilities from the failed ventures. The entire process illustrated the danger of using high-leverage debt to fund speculative expansion. When the speculation failed, the entire corporate structure collapsed under the weight of obligations incurred in pursuit of scale. Yoon Sok-kum, once hailed as a visionary, became the symbol of corporate excess and misplaced confidence, his audacious bets resulting in billions of dollars in shareholder value evaporation and significant fallout for thousands of employees whose pensions and jobs were suddenly precarious. The final act of the collapse saw the remaining core assets reorganized under a new entity, severely diminished, a ghost of the $7 billion behemoth it once was, all within an 18-month period following the Hanjin Heavy Industries misstep. The speed of the destruction was commensurate with the speed of the initial, debt-fueled growth. But what truly happens to a leader when his empire evaporates into thin air? And what collapse of Wongjin legacy did he leave as a definitive case study in the perils of aggressive debt cycling? Especially when diversification moves into areas the core management team does not fully comprehend. The initial $8 billion debt load fractured into manageable pieces only after the dismantling of its most valuable assets. The educational business, though salvaged as a separate entity, was forever marked by the taint of the collapse, forcing its new owners to undertake extensive rebranding to distance themselves from the insolvency stigma associated with the Wongjin name. Chairman Yoon Sok-kum faced intense scrutiny. While he was not criminally prosecuted for mismanagement in the same manner as some other high-profile bankruptcies, he was permanently barred from executive roles in South Korean listed companies, effectively ending his career as a major industrialist. His personal wealth was decimated, and the narrative surrounding him shifted entirely from visionary to cautionary tale. The lesson for South Korean conglomerates, the powerful chaebols, was profound. The era where cheap credit-guaranteed expansion was over. Regulators began tightening lending practices, specifically targeting cross-subsidy structures where stable businesses were used to artificially support high-risk ventures. The Wongjin implosion highlighted a systemic weakness: the temptation for founders to become over-leveraged on secondary bets, treating the parent company's credit rating as an infinite resource pool. For investors, the aftermath was a harsh reminder that due diligence on debt structure is often more critical than analyzing top-line revenue figures. The rapid disposal of assets, particularly Koei, showed that in a crisis, the market values stability over potential, and the conglomerate structure designed for synergy often becomes a transmission mechanism for failure. Today, the remnants of the Wongjin name exist primarily within smaller, specialized entities, stripped of the grand ambition that characterized the Yoon Sok-kum era. The sprawling empire that once aimed to touch every facet of Korean life is now a collection of smaller, cautious operations, haunted by the ghost of the $8 billion mistake. The question remains: in an economy still predicated on rapid growth and high leverage, have modern Korean conglomerates truly learned to manage the intoxicating allure of debt, or are they merely waiting for the next economic cycle to test the limits of their own fiscal discipline? Slow, reflective music fades in,